Hello, and thanks for tuning in for another California statewide economic and housing market update. My name is Jordan Levine, Deputy Chief Economist for the California Association of Realtors, and I'm excited to bring you the numbers for this week of June the 3rd, 2020. So things are improving in the data, and we're seeing many positive signs in our survey of realtors that we do each and every week, and we've been doing it for the past roughly 3 months. We're also seeing that good news start to filter through into the market data itself when we look at California's housing market. And we're also expecting that things should continue to improve as well. So when we look at the numbers on pending sales and new listings, those numbers are moving in the right direction from where they were in mid-April. We're also seeing a lot of other sources of light at the end of the tunnel. So at least for the next couple of weeks, things should continue to move in the right direction. What about prices? We expect some price impacts eventually as a result of some of the negative economic impacts that I've reported on with you all for the last several weeks. And again, that is expected to filter through to prices, but with a lagged effect. The other thing, or the on the other hand point to that, is that we don't expect price impacts in the realm that we saw back in 2008 at this point in time, based on what we're seeing with things both gradually improving and just the better fundamentals that we had relative to where we were back in 2008, that the price impacts will be in the modest category of just low single digits for 2020. And yet, even as things begin to and continue to move in the right direction, it's perhaps more important now than ever to remind ourselves that that recovery process will be slow. There's still lots of multiplier effects associated with the job losses, the hits to retail spending and GDP that will continue to play out over the next couple of months. And so, although we expect continued improvement, the economy will gradually open back up. We'll see fewer numbers of claims for unemployment, more mortgage applications, more pending sales listings. It's going to take a lot longer than many folks are hoping to get back to something that looks like quote unquote normal. In fact, most forecasters don't see us getting back to those long run trend lines until at least 2021, midway through the year. And I think that's a reasonable expectation. So let's talk about the realtor survey, where we have seen encouraging news. We've been doing this survey again for the better part of the last 3 months. When we talk about the most recent weekly numbers, we will be talking about the survey that we just concluded as I record this on Monday, June the 1st. And what we can see is that we're really past the peak, it looks like, in terms of both buyers and sellers holding back from the market. The percentages of folks who have actually had buyers not just get generalized cold feet, but withdraw their offer from a home that they had otherwise been ready to pull the trigger on, was down from almost 50% back in mid-April to less than a third of those sampled the week before last, that ended May 25th. And we see very similar signs on the sell side, with those numbers falling from almost 60% of realtors back in mid-April that had had a seller not just get cold feet, but actually pull their home down from the MLS. And those numbers have fallen consistently over the last 5 to 6 weeks to less than 50% of realtors that we spoke to again 2 weeks ago. We converted this over into a more weekly focused survey. So instead of asking cumulatively since the beginning of coronavirus, asking more about just what happened to you over the last week in your business. And we see that the percentage of realtors who have had a buyer withdraw the offer then falls to less than 10% of the market. And similarly, on the sell side, we see those numbers drop off to less than 1 out of 4 sellers have actually pulled a home down. And we will continue to monitor this over time as we move forward on a weekly basis. What's interesting is that you still see the sell side impacted more heavily than the buy side. And I think that still means that inventory will remain relatively tight. When you look at other sources of good news, we can see that more realtors are doing listing appointments last week. That number was up to 29% of members had actually done a listing appointment during that week, up from 27. So a modest improvement, but an improvement nonetheless. We saw that actually 23% of those realtors we surveyed actually got a listing and put a home onto the market. And again, that's up modestly from where it was 2 weeks ago. But again, another indication that things are moving in the right direction. We saw that 25% of members over the weekend reported that they actually had a home go into escrow. And that's been up for 3 weeks or 2 weeks in a row. We've been asking that question for 3 weeks, and that has continued to show signs of improvement as well. And in fact, almost 20% now had a home that actually closed. And that's again up from 15%. So incremental gains, but pretty consistent progress that we've seen over the last 2 to 3 weeks across a broad swath of indicators, both fewer folks backing out and more of these positive signs on listings, on pendings, and indeed members with sales that were actually closing. We also looked at the market data, and this stuff is showing up in the MLS as well. When we talk about the most recent week here, we will be talking about the week that ended Friday, May 29th. And what we can see is that closed sales indeed did find a bottom. We had a bit of a pullback last week statewide, but that was largely owing to a holiday, the Memorial Day weekend holiday. So we had one fewer day to close transactions, but you can clearly see that over the last 3 or 4 weeks that those statewide closed sales numbers have started to find a bottom. When you look at the week 22, which would be the week that ended their last week, those numbers were down again, largely owing to the loss of Monday. But overall, you could see that the pace of the declines had really decelerated those middle weeks of May, despite the holiday weekend there. When you look at it in terms of price segments on a statewide basis, what you can see was that actually the low end of the market, and I've kind of highlighted here in the thicker lines, the kind of $200,000 to $600,000 price segments were impacted much less earlier on than the higher price segments. But what we can see is that the growth there has become more negative consistently as we got through last week, with the holiday weekend, but they had already been trending more negative. When you contrast that with the top end of the market, you could see much bigger impacts early on to the 3 million plus category here, but actually those numbers seem to have hit bottom back in week 17, which was mid-April, and have shown some fairly decent growth up through last week before the holiday weekend stole some of that modest increase. And so there is a bit of a difference when we look at the top end of the market, which again, as financial markets took a bigger hit early and more rapidly, that we saw bigger hits to the top end of the market more quickly, but actually as financial markets have stabilized, the top end is starting to regain some of that lost ground, whereas the declines at the lower end of the market have started to accelerate of late. And we're seeing a lot of other sources of light at the end of the tunnel. It's not just in terms of our realtor survey or the closed sales that we dug out of the MLS last week. We also see the numbers for showings, and Showing Time is an app that you can use to schedule your show times with your clients. And those numbers have gone from being essentially 60 and 70% below where they were when we started the year back in the mid-April timeframe, to being just within striking distance of where they were at this time last year. In fact, we're 10% above the pre-crisis peak that we were at back in early March before the shelter in place, and we're only 1.5% below where we were at this time in 2019. So we've made tremendous progress after very significant impacts that kind of corroborate what we're seeing from realtors and in the MLS itself. We also see these numbers in the jobless claims, right? We've gone from a point in time where we are adding almost 7 million people to the unemployment roll weekly down to just 2.1 million in the most recent data. That's still a significantly elevated number of folks actually having to file for unemployment. But again, you can see that this number is also trending in the right direction. Consumer confidence, you can't really see a big noticeable uptick there, but actually we had a bit of an increase in May after one of the biggest declines in almost 50 years for consumer confidence. And so although we have lost a lot of ground and still have a long way to go to make up that gap, the data at least is showing that the declines have really started to decelerate and in fact move in the right direction across a whole slew of critical indicators as we measure this. That's not to minimize the impacts or to say that things are not challenging. They still are. They're just not getting more challenging at a faster pace. And indeed, when you take it a little bit closer to home and look at new mortgage applications, we're actually on our 6th week in a row nationwide of increased mortgage applications. In fact, last week's number was the first time, and you can see this on the right-hand side, where we surpassed the 2019 levels of mortgage applications. And that is, again, the first time that we've seen that kind of an increase overall since before the coronavirus outbreak really started to take hold with the shelter-in-place impacts. Here in California, things are actually growing at an even faster clip than what you see in the rest of the United States. We're on our 7th consecutive week of growth, so we're on the leading edge of that increase, but you'll notice here that we're still about 1.7% below where we were back in 2019. That's because we were hit harder during this first part of the shelter in place, but we're actually recovering that ground more quickly and are just right below where we were in 2019, a far cry from being 30 to 40% below last year's level only just a month ago. And we should expect more progress next week as well. When we look at some of the forward-looking indicators, we can see that California's pending sales have made significant progress, again, from hitting bottom back in the mid-April timeframe. We had a bit of a slip last week down to 879 homes going pending on average every day. Again, that is largely because we lost one of our trading days there. Overall, pending sales have really moved in the right direction. And you can see that here when we look at the week-to-week changes, that we went from a period of decline by almost 25 or so percent back in early and mid-April to about 7 weeks in a row of consistent growth in pending sales up until last week again, where we had one holiday day that drug us back down. But overall, things moving in the right direction, although we do see those pending sales starting to lose momentum if you average out the last couple of weeks. Week 20, we only grew by 3%. I think we borrowed some of the pending numbers forward into last week, and that's why we had a decent growth rate there, but we are seeing that pace start to cool down if you look at it on a 3-week moving average basis. When you look at it by price point, again, you can see that the lower price segments, 200 to 600,000 there, were not impacted as much originally, but they're also growing more slowly over the course of the last couple of weeks. We haven't had as much ground to make up in those lower price segments, but the slope of that curve there over the last 3-4 weeks, again, setting aside last week where we had this holiday-oriented decline, you can see that the lower price segments are not bouncing back as quickly. Whereas if you look at the top end of the market, much more significant impacts early on, fell much farther, much more quickly, but actually the top end of the market on pending, much as we saw with the closed sales numbers, have really been bouncing back since mid to late April and have been growing more quickly over the course of the last 3 weeks. And so again, just shows you how much those financial markets, which were hit more severely more early on, which have also stabilized and made more recent progress than, say, the labor markets, which are still dragging down and are just now beginning to drag down, frankly, the bottom end of the market. The top end has started to come back around. But the listing numbers do point to a recovery that's going to be fairly slow. In fact, when you look at California, I would argue that this is one area where we have gotten back to normal. We had a lot of progress made from mid-April through the midpoint of May, where the average number of listings going on to the MLSs each day was increasing. But over the last 3 to 4 weeks, and again, this most recent week, we did have the holiday, so we don't want to overinterpret that decline. But even without that decline, you can see that the previous 3 weeks here statewide have been relatively flat. We've seen that momentum, that increase in listings really start to peter out over the course of the last month. And so we see the demand side coming back, but supply, as is typically the case outside of crisis mode for California, that supply isn't rising to meet that challenge. And of course, you see that when you look at the weekly growth rate numbers, that the bounce back that we had for new listings, although it was down last week, and you can kind of ignore that negative 19%, which is basically the percentage of days of the week that we lost 1 out of 5. But even before that, again, you see that the increases in new listings were much more muted than we see on the pending side. And so again, this imbalance between how quickly demand is coming back versus how quickly supply is rising to meet that demand. And again, you see a similar phenomenon here, regardless of price category. So I'm still calling out those same top and bottom ends of the market, below 600,000, above 3 million. But what you can see if you focus in on the right-hand side is that increase in inventory that we saw from the midpoint of April onward has petered out across the board for all of our price segments. And that means that inventory will remain an issue, particularly as the demand side starts to come back. And of course, when we look at the price side of the equation, we can see that there have been only minimal price impacts thus far. In fact, when you look across the entire state, you can see mostly stable listing prices, whether we're talking about the Bay Area, the Central Coast. The Central Valley actually has list prices that have gone up a bit, as have we seen in the far north there in the Northern California, Sierra Nevadas, but also in Southern California as well. Mostly stable prices from sellers who are putting their homes up onto the MLS. We see the similar trend in closed sale prices as well, regardless of where we look in the state, right? We've seen minimal impacts both on the listing side and also what we are closing at. The thing that we do notice, though, is that there is a big gap in expectations, because when we ask sellers and look at list prices, we see minimal movements. When we ask realtors if they'd had a seller who was trying to reduce price to attract buyers, and this is a cumulative since the beginning of coronavirus, those numbers were only about 29 or 30%. That's pretty similar to what they are in a normal time frame. And yet, when we ask realtors if they have buyers who are expecting lower prices, those numbers are 75, 80, 90% pretty consistently. Now, last week, we converted these numbers over into a weekly survey so that we can keep track of this on a weekly basis and be more zoomed in just on the here and now. But when we asked about buyers expecting lower prices, still almost 2/3 of buyers that our members spoke to just last week were expecting lower prices. When we asked if they had actually had a buyer attempt to renegotiate the purchase price for a home that they were already in escrow on, 10% of realtors said that is actually happening. And so that's a non-negligible portion of the market that suggests that we will see some price softness. And indeed, when you ask about sellers last week had reduced prices, 17% of our realtors said that yes, they have seen at least one seller reduce price last week in order to attract buyers. And so we're going to be seeing, which side of this equation starts to move, because obviously this gap in expectations will have to play itself out across the market one way or the other. Either buyers are going to have to give up on their hopes of lower prices, or more realistically, we'll see some modest amount of concessions on the part of sellers. Indeed, when we look at the percentage of sellers that have lowered their prices on active listings in order to try to attract a buyer, presumably, we can see that that percentage has been increasing outside of the Central Coast. We see the Bay Area, Central Valley, and even modestly in Southern California, that the percentage of active listings that have cut price is finally starting to grow. So we do expect some price softness coming down the pike, and we see that playing itself out through the escrow process as well, where the percentage of closed sales that were reduced from the original list price have also started to increase. And there, the Central Coast also follows the same statewide pattern that we're seeing in Southern California, the Central Valley, and indeed in the Bay Area. All of that being said, I do want to end with some words of caution, because things are moving in the right direction. We've seen more positive news than negative news of late, and yet the recovery is going to take some time, especially to get back to that quote unquote normal level, or those long run trend lines that we were at before. And so I want to take this opportunity to throw a bit of a wet blanket on the mostly otherwise positive news that I've been able to share with you this week, so that we do have realistic expectations, at least for the next couple of months. And first and foremost, are those 40 million jobs that we have lost up till this point. We'll get new numbers in a few days, and I do expect that the number of folks applying for unemployment insurance will continue to trend downward, and yet we have over 40 million people in this country that have lost their jobs over just the last 2.5 or so months. And that is going to take a while, for the full implications of those effects to play themselves out. People had savings, they had government assistance that we could fall back on to mute some of the immediate blow, but this will continue to have ramifications for retail spending, people who are able to jump back into the housing market or make rent payments, bankruptcies, etc. And so even though these unemployment numbers move in the right direction, they will still continue to weigh heavily on our ability to recover, even as they also get better simultaneously. The other thing is, even if you only count just these 5 sectors that I'm showing you here, they account for more than half of all the 20 million or so non-farm jobs that we've lost. And so even if this 9.5 million bucket are purely driven just by the macro economy, and as things start to open up, those 9.5 million jobs come right back. 55% of the jobs that we've lost are in categories that will face ongoing restrictions. And so even as things start to get better, normal is still a long ways off. The other thing is, we see that there's been a lot of hardship across the housing market itself, right? Somewhere between 4.2 and 6.6 million people have been asking to skip mortgage payments as a result of impacts and just not being able to get there, and that is painful. So even as these numbers start to trend back downward, we're talking about millions of households that have been negatively impacted by this as it comes to their actual pocketbook and just making that payment for shelter. And we see similar signs on the rental side, where we've gone from 93% of households last year staying current on rent to just a little less than 91%. That doesn't seem like a big number, but with 43 million or so renter households, that almost 3 percentage point increase in people who are behind on rent payments represents another million or so households. And so when you put that all together, we're still facing significant distress out there. And that's why even as things move in the right direction, we still need to be very realistic about the fact that yes, things will continue to get better, but yes, they're going to remain challenging for the foreseeable future as well. And so, for my concluding remarks, I would just say that yes, things are getting better, right? We're seeing those sales numbers improve right alongside some of the forward-looking indicators, as well as in the external data on mortgage applications, on unemployment claims, on showing times. Those buyer demand numbers really have started to come back. But no, it is not time to celebrate. In fact, as I showed you, particularly when it comes to housing supply here in California, that the recent rebound we've seen on the demand side is being met with a rebound on the supply side that's really starting to lose steam and peter out. And so in some ways, we're back to our age-old problem that we've had in California, the Bay Area, Southern California, you name it, where we've got more demand for housing than we've got available supply, and that is ultimately going to hold back the market as well. Keeping it really real, we have had deep damage done, and the multiplier effects associated with having 40 million people out of work will continue to play themselves out, even as the economy starts to open up and many of the indicators that we look at with respect to housing move in the right direction. And so, yes, we will continue to improve. Yes, we can be hopeful, but yes, the recovery is also going to be very slow. And of course, COVID-19 remains the wild card. And if we do have a second wave in the fall, then we'll have to come back and revise the more optimistic outlook that we have for you here today. So my message is to be encouraged. Things are moving in the right direction, but also expect it to remain tough because there's been a lot of damage done that will take time to work through. Thank you so much for joining me for this update. We will be back in a couple of weeks. Feel free to leave us comments and let us know how we can be more valuable in these analyses. And until then, stay safe, and we'll see you on the next one.